Okay, the Fed funds rate ticking up a little bit. So yeah, that's what I was saying. I was thinking that there was going to be a bounce for maybe a few days and it was going to start going again, or it would last the week and maybe start going down the next week. But since there's been kind of an uptick in the people's confidence in the Fed, I think that we may have a bigger bounce than I was expecting before that, or I should say than the market was expecting before last week. Uh, what you have to realize is moves that are made now that are planning for something in the future will bring about volatility because the market isn't just going to move directly to the price that it should be. It's going to bounce around a little bit. People are going to over and underestimate what this means. And there's a little bit of elation right now because people are feeling like, oh, yay, they've got it. This is great. We don't have to worry so much anymore. But we're not done, right? Everything is still the way it was before this Fed meeting. But the thing that has changed is the hope that maybe things will be a little better. So I'm thinking since this stuff is going to take some time to bake in, when we get the next set of inflation numbers and the next GDP number, we're going to see a little bit more volatility because those are probably still going to be high. I don't think the CPI is just going to suddenly come down because the Fed decided to put up interest rates this month. No, it's going to take a little while. It's probably going to have to work its way into the system, just like you're seeing right now. I mean, think about the food shortages, right? So we've been hearing about food shortages for quite a long time, and we in the stores there have been bare shelves, but for the most part, you're still seeing everything stocked, and you can get most of what you want. And the same with price increases. You at first you weren't seeing a lot of price increases, maybe some here and there, but they've been slowly ticking in because you have to kind of cycle through the current set of goods, right? A lot of production and selling items all have to do with a cycle. Like you get everything shipped to you, you put it out on your shelves, you have maybe a little bit of stock in the back, maybe you're a chain and you have big warehouses full of stuff. So you kind of have to work through what you have first as you're getting the new stuff in to replace it. But what we have is kind of an interesting situation right now, and I kind of talked about this a little bit in the past. But retailers have a glut right now. A lot of retailers think places like Target, Walmart, etc. They have so much inventory that people don't want that they're actually considering paying you to keep items you're bringing into return. Now, I just read this story and I thought it was hilarious. It's stuff that's happened before. Amazon did it. And you think, man, that's ridiculous. Why would you do that? Because anybody could just go, oh, I'm going to buy this item and then I'm going to return it and keep the item plus get my money. It's a win-win for me, which yeah, I mean, that's a definite possibility. So doing things like this, you have to be careful. You can't just go ahead and do that willy-nilly. You got to actually monitor the situation and figure out how to keep people from scamming because everybody's first thought is going to be that, right? Everybody's like, huh, why don't I just go get that and then I'll just return it and get the money back for it. And they're thinking about this mostly for the bulky, lower priced items because you have to weigh the cost of storing one of those versus the profit you would get selling one of those things. And that's what they're doing with this inventory. They're thinking we have so much inventory right now that we have to get rid of it because it's costing us money to hold it. And a lot of the stuff is stuff that people don't want. So what do you do with that? Well, you sell it at a discount, and that's kind of what they're doing right now. Target announced their discounts a few weeks ago or something like that, and it tanked the stock even more. But that's for me, that's a good thing because Target in the long run is a decent buy, and the farther it gets hammered right now, the better. So looking at this inventory situation, you could think, all right, that's actually a good thing for the market because that could lower the chance that the Fed jacks rates up too high. Because the Fed is basically looking at everything that they can and making a decision based on that. It's not just the markets, it's not just the CPI, it's a whole mess of things. They're looking at the housing market, they're looking at how producers are doing, they're looking at how consumers are doing, they're looking at automotive, they're looking at trade, they're looking at everything. So having this glut is good in the sense that the Fed may not have to raise rates as high because it's kind of a sign that inflation may be peaking. All this inventory needing to go at cheaper prices. So there's that. That I thought was interesting. Powell touched on that a little bit. The other thing he said is we haven't seen the full effects of the China lockdown yet, which goes right back to what I was saying about taking time for things to bake into the economy. Having something shipped to your warehouse takes a little bit of time. And then, of course, putting it out on the shelves and selling it takes a little bit of time. And once you've gone through that, are you able to replace that item easily? Well, it's been harder to replace some of the stuff with the zero COVID China lockdown policy. However, I think a lot of that is picking up. I think a few provinces in China are opening up, and it seems like more and more things are going in that direction. But we'll have to see. the whole, I guess the whole point of everything I've been saying so far is just that it's going to take time for a lot of this stuff to bake in. So don't expect things to change right away. They're actually going to have to move a little bit over time before they change. You're going to have to feel the effect slowly. And then once things get better, you're not going to notice it right away because the slowdown part has fully crept in. So you're going to see shortages for a while, even as goods are coming back through the supply chain. Considering, I know I've mentioned this before, but we have a just-in-time shipping economy, meaning that most places don't want to pay to store their goods, so they will sell things and they will have an order schedule set up to have new ones come in right as they've gotten rid of the old ones, so they don't have to pay electricity for a warehouse. They don't have to pay workers. They don't have to buy pallet jacks and shelves and other utilities. It's expensive to do all that stuff. But when you have a slowdown like this, it hinders you because then you run out and you have to wait until the previous links in the chain can catch back up. So we're going to see a lot of weirdness coming in from that. And that's another reason why I think any rallies that are coming up might get crushed, because people are going to get a little optimistic and then it's going to get slammed down. Hey, Jabari, thanks for the follow. Good to see you in here. I appreciate that. I'll have to check out your stream a little later. All right, so we talked about the China lockdowns. There's constraints on on housing production right now. There's not enough housing at the right price, which means that there's still going to be an issue with housing prices staying high, even though interest rates are going up. So we have to look at interest rates as a way to put pressure on houses, right? If you have a loan for a house, you're going to be paying X amount. If the interest rate goes up on that loan, then you're going to be paying more for the same house. And that's kind of a way to put pressure on the market. So if you drop people's ability to afford a certain level of house, then you'll stop buying in that. And as people drop down, they may not want to buy a lower tier house to them at least. So it might end up dropping prices more because sellers are going to have fewer and fewer buyers to come in, which incentivizes them to drop prices. That hasn't happened yet. So we have interest rates going up, but we have a supply shortage of homes. So we kind of have these two things battling. So to me, that seems like it's going to be more stagnant. It's just kind of hang out before it actually drops. But this kind of stuff is good in the long run because prices should drop. I mean, the more pressure we put on everything, the quicker things are going to drop, which will cause the Fed to stop their tightening sooner. And that's what we want. We want the Fed to stop tightening as soon as possible. Some of the estimates have the Fed tightening for the next 2 years. Originally, that wasn't the plan, but they've recently said, all right, we're gonna put rates up between 3 and 3.5% this year, and next year 3.5 and 4%, and then hopefully tapering down in 2025 or so, 2024. But we'll have to see. It depends on what happens. If they taper down sooner than that, then we could have a big rally, and I think that's a possibility because we really just need to see a lot of this stuff finish. I mean, the Ukraine war is the big one right now because it's really putting pressure on commodity prices. They just happen to export a lot of food and energy, oil, which is what's driving a lot of the inflation right now. I mean, oil is still insane. In fact, let's take a look at oil and see where it is just for the fun of it. USO. If you look at this, ever since that pandemic drop, it's just been going up and up and up. Wait, was this later? Oh no, this was after the pandemic drop. I think this was when oil went negative for a little bit, which was pretty amazing. Somewhere over here, oil hit a point where it went negative because a trading firm or a bunch of trading firms had oil futures contracts at expiration. And with futures contracts, you actually have to take physical delivery of the product when it expires. You can't just be like, oh, I'm trading this. It's like, no, you own that oil now. You have to take delivery of it. And you're not just taking delivery of a few barrels, you're taking delivery of thousands and thousands of barrels of oil. So they didn't have anywhere to put this. They couldn't do it. So they had to pay somebody to store that oil. So there's somebody that lucked out enough to not only get paid money to store oil, but they also owned the oil. So they got paid to have an asset that's now worth a fortune if they held it this long. So who knows? But it looks like we've actually had a little bit of a drop recently in the USO. That's kind of interesting. Is it the same way if we look at crude futures /CL? Let's zoom in on that and see what we got here. Yeah, it's about the same. We've been having a little bit of a drop. That's probably going on with most commodities right now because we've had a little bit of a drop in commodity prices, which is bullish for inflation. The Fed's going to look at that too. So the glut in the retailers' inventories, that's bullish, right? The drop in commodity prices, that's bullish. That could cause the Fed to slow down a little bit. Although the rhetoric this week didn't really seem as slow. This the excitement is more coming from the outside edges of the market, not so much the Fed. The Fed is kind of staying with their story. They haven't really changed anything since the interest rate hikes a week or two ago, whenever that was. I think it was last week. I already forgot. It's interesting how quickly you forget things. One thing Powell said, now here's something that's not as bullish, that a soft landing is going to be a challenge, but it's their goal. The Fed's goal is to have a soft landing with rates, and what they mean by that is bring interest rates up enough, and or I should say QT, quantitative tightening, needs to increase enough to bring prices down without crushing the labor market. However, Powell kind of admitted that that's going to have to be what happens. He says they're going to do their best not to hurt the labor market, but the thing is, you can't really do that. A strong labor market depends upon enough capital to pay workers. And if you're tightening everything that companies use to generate that capital outside of their own sales and things like that, you're going to cut down the ability of people to hire new workers. So at the very least, hiring is has slowed already. It's still unemployment is still low. We'll get the numbers next month for the next one. We'll see what it's at now, but it's going to probably have to come down a little more because not only are they going to have to slow down, but they're going to have to stop hiring. They're going to have to cut sections when interest rates go up. In fact, Ray Dalio actually made a comment. Where do I have this in here? So yeah, Bridgewater's Ray Dalio doesn't like the rate hikes. He says the Fed should be subtle or will cause stagflation. He doesn't like the buying power reduction because buying power allows organizations to pay off their interest. Basically, what he's saying is the reduction in the ability to get cheap money prevents large organizations from paying down the debt that's causing a problem right now. And he's right about that. Now, he's making the statement because he himself is probably getting squeezed and he wants to have the cheap capital and make money like he has been. So he's incentivized to kind of say this is not a good thing. And he's not wrong about a lot of this stuff. They should be a little bit more subtle. If the Fed had acted sooner and been a little bit more light-handed on their rate increases and I should say quantitative tightening in general, then maybe we wouldn't have to slam them up so quickly. And see, that's the other reason why I don't think a rally is going to last because we are doing this really quickly, and we have another rate decision in like 3 or 4 weeks. Let me pull up the calendar here and take a look. So somewhere around here, I think like the 23rd, 22nd, yeah, 22nd of July. Oh, that's June. Never mind. I mean July. Yeah. So the 27th. Yeah. So somewhere around the 26th, 27th, there's going to be another Fed meeting, and they're going to probably increase by between 50 and 75 basis points, assuming everything stays the way it is by that point. We'll have to see where the war in Ukraine and the shipping problems are and what the CPI number is that comes out in July, because that's a big one. The CPI is going to influence them a lot, but it's really going to influence the market a lot because even though the market is forward looking, it's very fickle and they make judgments on a dime. See, this is why when people say there's no way to make money in the markets, I completely disagree because overreactions are how you make money in the markets. Let's see what we got here. Life of Ronin, what's going on? Hey, if you want to check out an interesting and fun gaming channel, check out Life of Ronin. I've been hanging out in his streams. He's been so much fun to talk to. He's engaging. He's a chill guy. I highly recommend checking out his streams. Go hang out with him. He streams a few nights a week. Thanks for coming in and checking it out, Ronin. I appreciate that. Shout out to you. So let's see, where was I on this? I completely got sidetracked. Oh, yeah. So that's why I think a bounce is actually going to get crushed, and we're going to have some more downside movement because we have so much weight on this, and we're jacking up rates so quickly that I can see things getting crushed down faster, right? So there should be a bounce. We're a little bit past a bounce. So let me go back to the SPY so we can actually get a long-term view of the S&P. Let's see, scroll in a little bit. So yeah, you can see we're on the daily now. You can kind of see how we do this little bounce thing right here. We came up. This was the first interest rate announcement when they moved it up 25 basis points in March. You can see that squeeze that happened right after. That was pretty expected right there. There was a lot of pressure because people thought maybe the Fed wasn't going to do anything or they were going to do very little because they really hadn't done anything yet. This was the first one in a couple of years, and it was a small one. It was kind of like a way to ease into it a little bit. They don't want to just slam rates up and scare everybody. They were just kind of starting. And then you had the second one, which was like 2 months later or so, I think in the middle of May, somewhere around here, which that one didn't last that long at all. It came down the very next day. In fact, this might have, no, that's too early. It would have been more in the middle of the month. It was probably here. Yeah, probably pumped up here and then slammed down the next day because I remember that. Um, But that one was a little bit more expected. People were thinking. I think people were more divided at the last rate announcement. Some people thought they should have gone a little bit faster. Other people thought that maybe they were going a little too hard and they needed to slow down. So I think it was a little bit mixed. But now we're kind of all in agreement that this has gotten out of control and they need to go a lot faster with rates. And that's going to put so much pressure on the market that at some point the bounce is going to get crushed. And right now what we've had is lower highs. If you look at every one starting at the beginning of the year where the peak was, we've got a lower high here. Right? We've got a lower high here. And we've got this, which could be another lower high. I don't know if it's actually going to be this time because we have a little bit of a different view on the markets now that people are a little bit more bullish, thinking that the Fed is actually going to be in line with inflation and be able to stamp it out sooner. So, what you want to remember is the more pain we have now, the better it is for us in the long run because we're going to get things under control. Yes, the Fed should have done things sooner to make this not as difficult on everybody, but we're in the situation we're in now, and we either do this or we mess it up and we have serious problems. It's like surgery, right? Sometimes you have to cut a little bit of the good tissue out to take care of the problem. Otherwise, it can come back. And that's what we're looking at in the markets. We need to make sure this goes down now because if it takes off anymore, we start getting into like, Venezuela and Weimar Republic territory where money is ridiculously valueless. So let's keep going on with what Powell was talking about. So, by the way, he was saying all this to Congress. This happens a couple of times a year. It's mostly just a way to kind of make it look like Congress cares, like they're actually doing something. But really, it's all talking points in politics. Powell will say what he says, and then whatever Congress person will throw their little spiel in there to try to get votes. But that's normal. So he's kind of telling everybody with this one, sorry, the labor market's going to have to take a hit. We're going to do our best not to have that happen, but that's going to happen. So that's another reason why I think rallies will get crushed too, because people are going to see that. They might see unemployment tick up a little bit and think we're going in the wrong direction. But no, that's actually expected, unfortunately. So the next thing I wanted to talk about was, here's what interesting. When Powell was asked about 100 basis points hike, which is a full percent, he said he's not taking anything off the table. He didn't even say, no, we're not doing that. That's not likely. He just said, no, we're not taking anything off the table. So if it looks like things haven't slowed down by the next meeting, then I could see them going for a 100 basis point hike. I don't think that's likely. I think the most likely hike is going to be like a 75. My guess is kind of about a 75 now. I'm thinking to meet that 3.5% target, the very minimum would have to be 50. So 50 would be the low side now. 75 is kind of in the middle where I think it's going to be. And the 100 basis point is more towards the top. So that could happen. That's yet another reason why the market probably will go down after this rally. I don't know if the rally is going to be a lower high or if it's going to be equal to that because there is a lot of volume. In fact, let me get out of this and go to the volume profile so we can actually see where this stuff lines up. I have to minimize this one and then open this one up. So this one has my indicators all over it. So I usually make fun of people with a bunch of indicators, but I actually kind of like these ones. The standard deviation channels are these lines right here, which tells you what's the likely range of moves between 1, 2, and 3 standard deviations. And 3 standard deviations is going to cover most moves. So it's basically telling you in so much time it's going to be within this channel. And you can see the channel's rising. And we're way above the median. This dotted line right here in the middle is the median price. Based on all this trading, all the volume throughout the entire length of the SPY, because I think I have this going back to its very beginning. The projected median in the standard deviation channel is right here. So we're way above that. We're at about 3/4 of a standard deviation. So we got the half mark here and the 1 standard deviation mark here. So we're really not that bad. People thinking about, how bad this crash is, not bad at all. I mean, this was the all-time high right here before the pandemic crash, and we're still well above that, right? So let's zoom in a little bit so we can see. So the reason I wanted to bring the volume profile up was because you can see right here we have a very low section of volume, right? If prices are going to fall, if this comes back down, right here is very thin. So we could see a big drop from the bottom of this candle all the way to where volume starts to pick up again, which guess what? Look at where it is. The top before the pandemic drop. That makes sense because a lot of shares changed hands here. You can see after it dropped and came back, there was high volatility when it hit this level again, which is normal for stocks. That's why there are people that trade breakouts. They want to wait till it gets to a previous high, see if it goes above it and holds before it takes off. And that's a common trade. I'm terrible at breakouts. I've never been able to really trade one successfully. I think, well, I mean, maybe I did one or two. I don't know, but it's just not my kind of trade. But it's something to pay attention to. To me, it speaks of an area of support, which tells me if it falls, it could chill around here before either bouncing or maybe going a little further. But you also have to realize the farther this thing falls, the more resistance it's going to run into. It's like, going down, it's like the pressure in the ocean. The farther down you go in the ocean, the higher the pressure is. And at some point, there's going to be a price low enough to where a big entity will say, nope, I will buy every share there is at that price. And as you go lower, you get closer to that. If you think right here, you see this big volume spike, which is like one of the biggest ones until you get down to the real volume, was right in the middle of the mess. If you go back to the 2018 year, which you can tell 2018 was right here because this high volatility area was because of the trade war, and this little drop right here was because interest rates got pushed up too high. You know how high interest rates were at that point? Two and a quarter, two and a half, somewhere around there. And you got to think we're like at one and a half right now, between was it one and a half, 175. So we're getting close to that area. And if we get another 75 basis points, then we're right back up in that area. And that was too high for people right here. And they're talking about another basis point on top of that. On a basis point, another percent on top of that, another 100 basis points higher than it was when it caused this mess. So there's a lot of support down here if things fall that low. I'm not sure they will. My thought is that we're probably going to have a little bit of a bounce and then come down a bit and maybe start bouncing around this area because at some point we're going to get to the lower rate increases. We're going to get to a point where the Fed feels a little bit more confident in how things are going and they don't want to jack rates up quite as high. That at that point the market's going to price in a much higher price in the future because they think things are going to be under control. However, we're going to get little scares and because of all this volatility, I'm waiting. And that's what I want. I want it to break this low volume area right here because as it gets back down here, I start to get more confident in buying stuff. I have been buying throughout most of this. Very little. I'm trying to keep my buying to a minimum because if this continues to go, if we end up having way more problems than expected, I don't want to be trapped, because there are a lot of people that started buying like way up here and they're out of bullets already, which is it happens when you haven't been in the markets that long and all you've seen is up, 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 up. A dip like that looks like an extreme opportunity because if you got a dip like that over here, you could have made so much money. But I mean, look at this. The only real volatility we had was when we got to old highs. And then when we got to right here in September, which that's usually a high volatility month where prices go all over the place. And this was where the Fed started saying, hey, we're going to actually talk about what's going on. We're going to start this rate increase soon. That's why the market capped right there because people went, all right, the fun's over. All the cheap money that's come in through this channel right here is now gone. And that's what we're seeing. But we have to see the effects of that. And I mean, look at how big the candles are. Let me zoom in a little bit. So this is the weekly chart. I mean, you can see that these candles for the week are huge compared to what they were in 2021. These are very low volatility candles. It's just kind of ticking up higher, not really doing all that much. Maybe it levels out and consolidates here before it keeps going. We are getting these giant moves up and down every which way. So I don't think that's over. I'm expecting things to get a lot worse from here. But we could have a decent little bounce. In fact, not only could we bounce up here, but we could bounce up through the averages, maybe up into this mess up here where the volume really picks up. And if there is too much mania or there were too many shorts, we could even go back up and test old time highs. Now, I don't think that's likely. I think this channel it's probably going to get interrupted a little bit with the lower highs. Like I have a feeling at some point we're going to break this high right here, but it could just keep going lower. So I'm ready for that. I'm conserving a lot of my capital. Mostly what I've been doing lately is trimming the positions I'm less sure of and keeping the ones I'm sure about, but making sure I have a good amount of cash in case we have a serious panic. So let's get on to the rest of the stuff Powell was saying before I get into some stocks, because actually I have some interesting earnings news that I want to talk about. Candles. Okay, Ronan, let me help you out here a little bit. So this is a candlestick chart. I mean, they call it that because obviously it sort of looks like there's a candle body and a wick. Let me zoom in a little bit more so you can see. It's kind of hard to tell. I was trying to find one at the top that actually looks like a real candle. This one right here. So this looks like an actual candle with a wick. What that's telling you is the full range of trading in this time period, because each one of these candles represents a time period. And in this chart, it's a week. So this 1 week candle right here is saying it opened right here. It moved up a little bit to the top of the wick because that was the top of the trading range for the week, and then it went down and closed here. So the way you look at it is the body is where it opened and closed for that time period, and the wick is the full trading range. So a wick kind of tells you that price will get rejected off of a certain level. See right here, every time price went lower, it got pushed back up and closed up higher. See, we went down but pushed back up. Went down but pushed back up. So wicks are actually important because they kind of give you an idea of where the buyers and sellers start to come in. So the lower it goes, the more the buyers come in, pushing the price up. And the other direction, if you look at this one down here, the higher it goes, it gets pushed back down by the sellers because too many sellers come in. So these candlesticks charts are a really effective way to look at the market and understand what actually happens. And you can change the time period of these. These are set to a week, but I can set them to days. I can set them to minutes, hours, whatever. I like doing it over the week right here because this gives me a nice broad picture of what the market's been looking like for the past few months. So this is going back to about a year and a half, right? So about to February of last year. Each one of these is a week, and you can kind of get a sense of direction on that. And you can see where the trouble turned everything around, right? You can see right here is where the Fed said, hey, all this free money is going to stop. The market kind of panicked a little bit. And then at the new year, because that's usually when positions get readjusted, things started to go down. People took their profits. They already locked in their tax year at the end of 2021, so they don't have to worry about changing any of that. Now they're worried about what their portfolio is going to look like in 2022, and there's been high volatility. So these candles are giving us a clear picture of what's going on. And you can see they're bouncing, right? It's not a straight drop down because we're not at the end times, right? The market's not over. Economy's not going to be dead in the water or anything like that. There's so much FUD going around, which stands for what? Fear, uncertainty, and doubt. Basically, just people trying to scare you, right? To make money off of it. But what you're also seeing is people are unsure about what's happening in the future. So these huge candles are saying that there's uncertainty going on, right? Like people felt it was the SPY, which is let's just say the S&P 500. People felt the S&P 500, which is kind of a measure of the U.S. economy, was fair priced anywhere in this candle. Some people thought it was good down here. Some people thought it was good up here. So you can see that people do not agree on what the market should be right now, which is why I think we're going to see more of this. And these big candles are a chance to make money. I mean, if you think about if you bought in down here and had this huge bounce, you made a ton of money, right? Or if you shorted up here and caught this drop, you made a ton of money. So you're going to have more opportunities to do stuff like that. And as this drops more, assuming it does, because you never really know for sure, but as it most likely to me, I feel like it will downtrend more. That's an opportunity to buy. That's an opportunity to look at the stocks that you really like for the future and start adding a little bit more because as things go back up, it's hard to get in. For example, last year, if we can look at the chart a little bit in a little bit longer term view, I had so much trouble making money in this. You think this is when right here, this is where the pandemic dropped happened in 2020, right? You can see this giant drop, and then everybody was coming in, new traders were coming in throughout here, and everything they did went up. They bought some stocks. It just went up. They didn't have to do anything. But now they're in a market where they've never seen drops like this before. So a lot of people are getting wrecked in this. A lot of these people that all they did was buy and made money, like, ha ha ha, I could buy whatever, and it just goes up. They're not doing well. And they're the ones that are going to be leaving the market. In fact, a bunch of them already have left the market. And that's what we want because those people coming in, they're kind of like fair weather fans. They're the ones that drive this price action higher and higher, right? We had this big crisis and there was a bunch of readjustment of capital. And then suddenly, as people felt more confident in what was going on because the Fed came in and said, "Hey, we'll buy your terrible debt so that you don't have to go bankrupt." The market said, "Oh, cool, we can bounce now. The Fed's just going to take care of all the problems for us." So that was the reason it was going up. And the increased number of buyers wanting to get in was the pressure that kept it going. Now those buyers are leaving and confidence is dropping to a multi-decade low in the market. A lot of people don't feel confident that the market is going to do well in the rest of the year. And they're probably right. I actually agree with that. I think by the end of the year, the market is going to still be low. I don't necessarily think we're going to beat all-time highs here unless pressures like the Ukraine war, the shipping problem, the supply chain, and inflation all come down. But that's a lot to ask for all at once. Any one of those things, I think, will cool off. My thought is the Ukraine war at some point will probably finish because I remember hearing months ago that Russia had a multitude of objectives and they achieved all but one. Right. And there's also been little rumors here and there that maybe there's going to be peace. A lot of people don't think so, but I just keep seeing these stories pop up like maybe there's going to be peace, maybe there's going to be peace. So there could be. So I want to be prepared for that just in case there is, because that's going to be extremely bullish for the market. If the war stops, then fuel prices come down and food prices come down, which are the two main drivers of this inflationary problem. So I'm thinking could let up, and that could be very beneficial to the market. The shipping problem is going to have to work itself out, but that is going to take time because each link in the chain has to get going before the next one. So everybody's basically waiting for the link before them in their shipping chain to be fully operational so that they can be, which is why things take so long. And how far along that is, I don't know. I expected it to be pretty much fixed by now, but we're still having those problems. So who knows? Okay, so let me move on a little bit here. What else? I got to finish what Powell was saying in this meeting. So Powell is thinking he wants compelling evidence that inflation is coming down, and they don't have that yet. So that's another reason why I think the rate hikes are going to continue to be more intense. The Fed funds rate sets the rate at which banks lend to each other, and the Fed lends and all that stuff. But those banks then also kind of translate that to the lower echelons, i.e., us, and they tack on a little bit more. So if you get an interest rate on your house, it's not going to be 1.5% like the Fed funds rate. It's going to be like 3 to 5% because it's going to be higher than that. That's how banks end up making money on top of that. It's like throwing your commission on there, basically. So there's still evidence that they're going to have to keep raising rates higher, which is going to put pressure on the housing market, which I like because I would like housing prices to come down quite a bit and be able to get into one since they're insane right now and the supply is low. It's also going to drop the market, because a lot of borrowed money goes into the market. A lot of these firms actually use it to pump up their stock price and their portfolio. So having that stop lowers the pressure for everyone else, right? Like a lot of that was what was driving this pump last year. It wasn't just new users coming in. That was a big thing. In fact, it was a perfect storm of a whole bunch of stuff. But having the capital for businesses to keep buying their own stock back or firms to just add to their portfolio and borrow more money was another reason why this was going up. And all of that stuff is going away right now. Let's see. So the next thing we got here, let's see. The labor market is unsustainably hot. Risk to unemployment is high, and it will probably go up. So he's telling you right there that the labor market's going to get crushed. That was one of the most important things in the entire market. The labor market is going to have to go down, and that is going to freak the market out. So he's basically telling you, like, hey, look at these rallies and be ready for them to be crushed as time goes on because there are a lot of things we're going to have to tamp down, which is why I'm okay with the bounce. I think a bounce is healthy. We need to redistribute a lot of those shares into stronger hands so that when we go down some more, we have the ability to bounce. Like shares have to be in the right place in order for the market to go up. Because if people that are just trading them and don't know what they're doing have a bunch of shares, that's when you get high volatility because they'll just drop it at a moment's notice without knowing what they're doing. But once a lot of those hands are out of the market and the stable people, the diamond hands people, quote unquote, have the shares, then you have ground to stand on again. So that's kind of what we're looking for. We're looking for that ground. I don't think we've hit it yet, but I think we're getting closer, right? The Fed's talking about the September being a point in time where we can see what their policy has done so far. So I'm kind of looking at September for a possible bounce. But here's the thing: Septembers are usually volatile anyway. They're when a lot of traders start to come back into the market, but are still out from the summer. And there's a lot of repositioning. The United States budget restarts at Q3. So when you get into Q4, meaning October, November, December, you're in the new fiscal year for the United States. So a lot of those contracts, like let's say there's a defense contract that expires in September, you can see a lot of that volatility come up because people are unsure who's going to get the contract for the next cycle, right? So September is a time to see how their monetary policy has affected the economy, and September is a time to see repositioning for the next fiscal year of the government. So it's an important time, and that's why I think we could see a bounce after that. Because if monetary policy looks like it's fixing some of the problems that they can fix, then we could have some solid ground to stand on to bounce for there. So the last point I wanted to make that Powell was talking about was the balance sheet reduction. Now that's referring to the Fed's balance sheet, and what they do is they buy securities from other companies and hold them to help other companies have more money. Like basically. A company will go to the Fed and be like, hey, I got these, let's say I got treasury bonds right now. Will you hold these and give me some reserves so that I can lend to other people? And the Fed will go, yeah, sure, we'll hold on to that for you. And that gives the business more money to invest in the economy. In fact, that's actually how money printing goes. It's the Fed doesn't actually just have a money printer and well, I mean, they do for the physical bills, but they don't add the money to the economy. They have reserves that they trade to large investment banks who then loan to other banks. And in that loaning process, if you've seen anything about the Fed, new money is created. Like if you go to the Fed and you deposit $1,000, most of that $1,000 is going to be loaned off by being created again. So they're not taking your 1,000 and loaning it out. They're taking like 900 of it. Or no, I mean they're holding on to 100 of it and they're creating another 900 in a separate account to loan to somebody else. And you think about that with everybody that's borrowing money. That's actually how money enters the economy. So the Fed is trying to stimulate investment banks loaning with this whole balance sheet. And when they say they're going to let the balance sheet run off, it means they're not, number one, they're not going to add more securities to it. So that doesn't free up any space for these large banks to loan to anybody else. They're also just going to let a lot of the stuff they have expire and run off. And the estimate for the endpoint on that is $2.5 to $3 trillion less than it is right now. So that's a huge amount of money that's going to be basically taken out of circulation, so to speak, right? Because they're going to have to cover that. Some of these banks aren't going to want to loan past a certain limit. Right. And that actually brings up the next point. The Fed does stress tests every so often to see how well the economy will hold up in a crisis. And they actually did a stress test this week, and they found that all the large banks actually have enough money to sustain it. The Fed stress tests were much more intense this year than they were last year because things look a lot more dire than they did a year ago. So they wanted to make sure that if there is a crisis, these banks will be able to handle it. And they basically made a scenario where unemployment gets to 10%, GDP drops by 10%. Commercial real estate drops by 40%, and the stock market drops by 55%. Those are all large numbers. We're nowhere near those right now, but to the Fed, that's a worst case scenario. Is it actually a worst case scenario? I don't know. Maybe. But it's pretty bad. It's worse than what we have right now. And if that does come about, then the large banks are able to take that. They have enough capital to make sure that we don't have a terrible outcome because of it. So that's actually another positive thing. In 2008, a lot of the banks were not capitalized well enough to to handle that crash, which is why you think like Lehman Brothers and Bear Stearns, I mean, they went out of business. I mean, obviously because they had some shady business practices and they weren't taking care of their debt properly. There's just so much going on. These are 100-year-old companies or so that went out because, well, they weren't capitalized enough. They had too much debt. They were making terrible bets. They were basically taking on the risk of all these other institutions. And when the drop actually happened and they had to cover that risk, they didn't have the money to cover it. So sorry, everything dropped, right? So after that point, new rules went into effect where the Fed said, okay, banks need to have more money in reserves just in case something like this happens again. So now banks have more than they did before 2008, which is why I don't think we're going to have another 2008 right now. Because number one, the lending practices that led to it in the housing market aren't around in the same ways. I don't really know it well enough to explain it, but basically, regulations have been changed so that kind of a thing isn't as likely. It still is a possibility, it's just not likely. And the banks are way better protected against something like that, which is a good sign. Oh yeah, Harker. So Fed President Harker said we need to get to neutral quickly, which they consider about he considers about 2.5 cents percent. But he wants to be above neutral, so he wants to be in restrictive territory by the end of the year. And he thinks 75 basis points helps with that. So there's a possibility of another 75 basis point hike, which I kind of think is likely. He said he's undecided for the July hike, either 50 or 75, but I'm leaning more towards the 75 at this point. We'll have to see what the data says. When they need to move to a restrictive stance, how we get there depends upon the data, which is what the Fed says. So in September, there's going to be a lot of adjustment. If we have a nice rally, see, that's one thing. It's so funny that what happens in the market is kind of opposite of what we want. We want the market to go up as investors because we have money invested in that. But if the market goes up, that's going to be seen as a bad thing by the Fed because that's going to be seen as inflation not being tamped down. So any really big rally we have, if we for some reason have a rally that suddenly pumps way up here, that's negative because that would cause the Fed to tighten even harder, which could then cause a real crash, right? People are calling this a crash. I mean, I guess you could, but to me, it's more of a steady downtrend. I mean, think about it. This is 6 months into the year. It's taken 6 months to get this far down. I think this is about 20%, maybe less now that we've bounced. But look at what happened during the pandemic. 1 month, we dropped way more than that, right? It only took a few weeks. Look at that. 1, 2, 3, 4 weeks. We went from all-time highs down to lows that we hadn't seen in quite a while. And this is 6 months to get roughly the same, but not quite as much. So there's still a possibility that we could continue bouncing and that could be negative, but my thought is that it'll kind of correct itself as something negative comes out, because something negative always comes out. You can think everything's going to be smooth sailing, but something negative always comes out and it spooks the market. So that's kind of what we're waiting for in that. All right, so one of the other things I wanted to say before we move on, trade rep Ty said that Biden's moving forward with China, lowering some of these China tariffs on important things like fertilizer and components. Now, that will help with commodity prices because food prices are so high right now, and part of that is because fertilizer is difficult to get and it's more expensive. So easing some of these tariffs on China will allow more fertilizer from China to enter the markets and hopefully drop the price a little bit, which could spill into the commodity prices of food. So hopefully that will bring it down a little bit. They haven't done it yet, but from what it sounds like, since they've been talking about it for a couple of weeks, they are going to relax some of these. And I mean, these are tariffs that came in around 2018 when the trade war initially started. So some of these they never resolved their issues on these tariffs, but because they need the goods, the tariffs are going to come down. So it's like you can hold out as long as you want in a war like that, right? If you're going to be like, all right, well, fine, I'm going to hold my breath until you start talking to me, right? If somebody's ignoring you, like little kid stuff the kids would do, that only works for so long because eventually you have to breathe again, right? And that's the same thing with these tariffs. It's like they can posture towards China all they want and say, hey, we don't like the way you're trading with us. We don't think it's fair. We're going to put tariffs on your goods. Oh, and then a global problem happens and you have to go, well, I guess we're going to take those off. And then China just sits there and goes, ha, we're going to keep doing what we were doing. You have to buy our stuff. So that's probably what's going to happen. The tariffs are probably going to lower, and that will be positive for the markets. So that will hopefully ease a little bit of pressure there, but we'll have to see what the specifics are and how much they're lowering them. That's what we're kind of waiting for. But at this point, it looks like that's actually going to happen. So that's actually also bullish for Chinese stocks, which have been hit a lot lately because of so many different issues there. But if this goes through, that will actually be a bullish point for Chinese stocks. So let me see. What else do we have here? Oh, so U.S. refineries are urging the White House not to ban fuel exports because that's one of the ways that they can try to get the price of gas down is prevent some of this oil from leaving the country so that there's a bigger supply in the United States, which if you look, basic supply and demand, the more supply you have, the lower the price goes. And that's what they're hoping will happen. Refineries don't want to do that because they want to be able to sell their oil to the highest bidder. And if they're locked to only selling in the United States, then that's going to drop their profits. So that's why they're fighting it. But if this actually does go through, that will hopefully lower oil prices a little bit. How much that'll lower it, I don't know. Right now, we're already seeing the gas tax holiday. It's lowering oil by about 18 cents a gallon. But if you got to think about that, that's not really doing very much, right? Like I live in California and I drive by a gas station on my way home all the time, and the gas it's $7 a gallon at that gas station right now. I've never seen gas that high in my life. Now California has more taxes on oil than a lot of other states, so gas in California is going to be a lot more expensive. In fact, you may have even seen a meme of a town that's right on the edge of California and then one that's right on the edge of Nevada, and the gas is like $2 different or something like that. That's because California has a whole lot of emission standards and taxes for oil and things like that, and any kind of a greenhouse gas emitting fuel source. So gas is still really expensive. That 18 cents a gallon isn't really doing anything for people like me. I think the national average is around $5. So in some places I've even heard it's like in the fours, which is great for them. That's wonderful. But in more expensive places like California, that 18 cents really isn't going to do very much. And it's a temporary gas holiday, so we'll see how long that lasts. So oil is still looking up. It's down a little bit, and let's go over to oil again real quick. So I like the fact that it came down a little bit, and there are so many efforts to keep it dropping. But what are they actually going to be able to do that? Without the war in Ukraine stopping, it's going to be very difficult to actually get these prices lower. Now, I've been waiting for a little bit of a drop because through this entire pump, I've been saying, man, I want to get into oil. I want to get into oil. I wanted to get into oil. But I never have a chance because it just keeps going up. Now that it's been dropping, I'm considering maybe making a trade on it, but it's still up towards its highs. And regardless of what the situation is, what the fundamentals are, I just have a deep rooted fear of buying anything that's high up. Some people love it because you could look at this as, oh, maybe it's a breakout or something. But I'm looking at the fundamentals with oil. There's so much going on in the oil market that it's hard to actually know everything. I mean, you never really know everything about any kind of security you're looking at, but especially with something like oil that's so important because you got to realize oil is like a vast amount of our economy because it's not just fuel for, cars and planes and stuff like that. There's also like the byproducts that make plastics. There are other chemicals. There's just so much stuff that comes from oil, and it's such a huge industry that it's difficult for somebody like me to know everything. And when it's up high and I know that there's a bunch of uncertainty, I just don't really like it. But what I do like is that the lower it goes, the more we get into this thick volume. And in fact, once you get down low enough, you get into this point of control, which is where a majority of the volume actually lies. So that's telling you that a lot of people bought shares of the crude futures right in here, which is significantly lower. It's about $50 from where it is. It's $50, and right now it's at 106. So it's actually, you would have to cut it in half to get down there. And I don't necessarily know if that's going to happen anytime soon. But as it drops a little bit, it gets into higher volume up here, which I do kind of like. So if it drops a little more and it hits this like thick volume area right here, I might actually consider a trade to the upside, assuming everything is still the way it is at that point. But I like that. So it's coming into my area, but not quite yet. To me, on a trade like this, it has to be really, really good. I want to see a ton of red, and I still want the fundamentals to say it's going to go up, right? The chart has to tell me down, and the fundamentals have to tell me up. That's what I want to see. So right now I'm not doing anything, but I'm kind of looking at it. Okay, so the next thing, we talked about the retailer glut. A lot of inventory is causing some problems for the retailers, which I like. In fact, let's take a look at Target and Walmart real quick and see what their stock looks like. I didn't look too much at it this week, but look, oh, this is so beautiful. Look at this. So this was that giant drop when Target reported earnings right here that you could have made so much money on with very little. And I'm still kicking myself for not buying those contracts the day before. But look, it's come down even more since then. It did have a bounce with the market, obviously, but retailers are looking great. I mean, retailers were way up there. If you bought a retailer during the pandemic, you did pretty well. Because look at that. I mean, right before the pandemic, Target was actually coming down well before we had the initial pandemic drop. So once it actually started to go down, and they realized, oh wait, Target's still open. It had a huge bounce, and it was one of the essential businesses, so it was able to capitalize on the closures, because it didn't really affect it. It was lucky in the sense that it could stay open and also have fewer employees, and that's way better for your bottom line, right? Because that's the overhead cost gets cut down. And the foot traffic was going to be less, yes, but people needed a lot of these items. So they were basically guaranteeing sales of toilet paper, things like that, all the stuff that was being memed around because people were buying it like crazy. So they benefited from that. But now they're kind of on the other side of the coin. They have that glut of inventory and they've been driven way down. I like this. The median for the standard deviation channel is down at like 110, 115, and right now it's only about 140. It was 250, 260, something like that. So it's come down quite a bit. And for the long term, I like it. I think it's going to flow with the market now, unless it has some individual news. We've pretty much gotten everything for the quarter out. Like earnings, that was the big part. And then that second announcement where they said that they had too much and they were going to sell things at a discount, that killed it even more. So what other news is left in the stock? I don't know. We have to wait until next earnings season to see, which actually comes up in a little bit. So that's the next point I want to mention. We are about 2.5 weeks away from the next earnings season. Now, for me, that's a good thing because most of my trades are around earnings season. Now, my philosophy on finance is that you should have a diversity of everything, not just stocks, but a diversity of strategies. I've been kind of pushing this point for the past couple of weeks because I think it's important. To me, if you just do one thing, if you just invest in a dollar cost average fashion, or you just trade or day trade or whatever it is, you're going to run into problems where the market goes against you and you lose money. So if you're just investing and all you do is buy long and nothing else, you're a passive investor or you're an active long investor, you've been getting crushed. Your portfolio has gone down and down and down. Every month it's down lower. So that is not easy to deal with psychologically when you see your portfolio dropping every single day or every single week or whatever. But if you have a second strategy, if you're also trading while this is going down, you can add to your long position. So, yes, your long portfolio will be dropping, but you can get in at better prices for when you do have a bounce, and you can trade the downside moves and hopefully add some income to it. That's basically what I've been doing. I've been doing little trades here and there to try to make a little bit of money to add to my long account. When we had the Fed meeting last week, I ended up doing a day trade during Powell's speech. I got the perfect little green candle to make about 50% on my calls in 12 minutes, which was amazing. So I took that money and I bought a little bit. I added some to Tesla. I think I bought a little bit of crypto, or maybe I waited on the crypto a little bit. I haven't gotten any in a while. But the point is, I wanted to use those earnings to up my long portfolio as this drops. So the diversity of strategies is dollar cost average, a long account, and trade the little moves here and there. And I don't really day trade normally. I usually do swing trades, which means I'm holding stuff for, multiple days or multiple weeks or months because trying to trade on the minute, on the hour is just it's gambling. It's very difficult to do in my opinion. Some people are good at it, but I'm not. So I try to hold things for a little while. Like I'll get some shorts here and then I'll write it down a little bit and get out somewhere here. Maybe not at the bottom, but I'll take my gains from that. Right now I actually have a short on in Rite Aid. Let's take a look at Rite Aid, which is not going well. Rite Aid to me is a pretty good short in the long term because if you look at the chart, I mean, it's terrible, right? It does nothing but go down. Yeah, we're on the weekly, so that's fine. You can see it has these spikes, but overall, it's just down, 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 down. Now, in let's see, was this 20? This is 2016. So yeah, it was in the past. Rite Aid was going up and down. It was kind of volatile, but recently, it's just been nothing but a downtrend. So having these little spikes here and there are opportunities for me to short it. Because what I want to do is I want to get in at the highest average I possibly can and then sit for a little bit as it eventually deflates because it's kind of going to. But look at where we are right now. This is the volume profile, and we're in this green zone, which means we're in the point of control, i.e., the area where the most shares have traded hands. That's a big area. I mean, it's going from $18 all the way down to $5 or $6. So this is a huge range. But because we had this nice little bounce, we're coming up towards these moving averages. We're getting up more towards the middle of this zone. Rite Aid to the bulls looks good. And I'm okay with that. The shorts that I have on Rite Aid right now are very small. Yeah, after earnings, they took a decent hit, but I thought that they might bounce, so I didn't want to put it on heavily. I only wanted to do a little bit. My thought was, all right, if I'm right, I'll make a little money, but not much. If I'm wrong, I'm going to protect myself from a huge loss because I did think about going in really heavily on a short, but I thought, no, it's already come down quite a bit. They're actually sort of due for a bounce. I don't necessarily know if they're going to bounce at this earnings call, but they did. They actually, let me go to my notes right here and see what it said. So Rite Aid actually surprised to the upside a little bit, which hasn't happened in a while. I mean, you can see each one of these dots are an earnings report, and every time it's like, oh, maybe it bounces a little, but that was actually more the market that bounced it, not them. But it's just down, 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 down. They never really surprise, but they did this time. And I thought, man, that's possible. So I don't want to get heavy into that. They had an adjusted Q1 loss of 60 cents. The estimates were for 70 cents. So look at that. The estimates thought they were going to lose a little more. They still lost money for every share that people have, right? 60 cents per share. That's what EPS is. But just not as much as they were expecting. The revenue, i.e., the sales, how much money came into Rite Aid, was 6.01 billion, and the estimates were 5.75. So they took in a little bit more revenue, and they made slightly more with it than the analysts expected. That's a bullish uh, outcome. So that was a part of the reason why it started to jump. Now the real reason, the rest of the reason was because they guided up. Now I always say the two biggest movers of stock are one, guidance, two, analyst upgrades and downgrades. If a company comes in, they show you their numbers, that's kind of important as long as they're somewhat in line with what the estimates were. But the real issue is what are they going to do in the future, right? Because remember, I was saying the market is a forward looking instrument, it prices in these moves in the future. So when companies come in and say, hey, in the future, this is what we're expecting to make, the market's going to react to that now. And that's what they did. They guided up. So the estimates were that next year, or fiscal year 2023, they were going to earn 22 billion in revenue, but they guided up to 23 to 24 billion. So that's a pretty decent upgrade for them. They also earnings per share was estimated to be a loss of $1.41 for next year, the entire year, but they have now guided that down to $1.19 loss. So that's a pretty decent little uptick with everything. It's funny though because you look at that, it's all still a loss, right? They're still losing money, just not as much as before, which is why I think this downtrend is going to ultimately stay intact until they fix that situation. I mean, if you've been into a Rite Aid recently, you'll notice it doesn't look that good. They're usually kind of, I mean, they're not dirty, but compared to other pharmacies, they don't look quite as clean. Their shelves are a little bit more bare. The prices are ridiculous. I had to get some simple thing a few weeks ago, and I went into Rite Aid to look for it, and it was like $6 or $7 more per thing than it was in the other store that I was looking at. So I thought, nah, I'm just gonna go to the other store, like that's 3 doors down from this, and buy it there. So I think a lot of people think that when they go into Rite Aid. A lot of times they're only going there because it's the only choice they have. Some towns only have a Rite Aid, or there's only a Rite Aid within walking or driving distance. So they get that advantage. But when you compare them to other pharmacies, they're just not doing as well. They have way more debt that they still have to pay out, right? They don't have as good of an inventory. They're just their strategy isn't as good. There's just so much wrong with them. Now, I'm not hating on Rite Aid completely. I don't think they're like the most terrible company ever. I just think that expectations for them are overblown, which is why I like this pop. And I'm hoping it keeps going because my plan was at the end of the day on Friday to get into to up my shorts a little bit, try to get a little bit more downward exposure, but my thought is maybe if we get more of a bounce, then this could keep going a little bit. And if it goes a little higher, like if we can get it back up to, closer to $10 a share, I love that for a longer term short. I even like 8. So the last time I got in was this candle right here. You can see that it bounced quite high when an announcement came out that an investment firm wanted to buy them for $800 million. But the fact that it wasn't an actual offer, it was just something they were talking about, made it so that the market crushed it right back down. And that's what this wick right here is telling you. It's telling you that the market pumped real quick, or I mean, Rite Aid pumped real quick. And once people realized that there was no reason for it to stay up, it dropped quickly. But now, because they've guided up a little bit, there's reason for the market for Rite Aid to be up higher than it was before, which is why I think it could keep going. But that depends upon the market. If the market continues to bounce, Rite Aid will probably get, because it's gotten permission to ride the tide in a positive way, that will pull it up a little more. See, that's basically what earnings guidance does. It gives the stock permission to move in a direction that people want it to. People have been crushed on Rite Aid for a while, so they want it to move higher. It doesn't necessarily mean it's going to happen, even if you believe in it, but if it gets the green light, i.e., we're going to do better than we thought, then investors can start to, use their little imaginations and think, oh, how high could this go? Maybe they're going to do even better than people think. I'm going to buy even more. So, this little rally could keep going, which I hope it does. So, the one thing I wanted to talk about in that, I mentioned EPS a lot. Now, people that have been trading for a long time know what EPS is, but people that are newer, just to explain this a little bit, earnings per share basic EPS is the net income divided by the outstanding shares. So how much money did they make divided by how many shares of stock are available to trade. That's how EPS comes in. So Rite Aid basically lost 60 cents for every share they have out on the market right now. So there are two other kinds of EPS that you'll see regularly. There's adjusted EPS, which is the one that you'll normally see in the earnings report, and there's diluted EPS. So adjusted EPS is your regular EPS, i.e., the net income divided by the outstanding shares, but you non-recurring events being subtracted from it. So let's say, a business has an extra building and they sold that building in Q1. They would have that income in their balance sheet. So people would think, oh, look, this company has more money. But if you want to use adjusted EPS, you can say, okay, yeah, it looks like we made you a lot more per share, but we also sold this building and we're not going to be selling buildings every quarter. This is a one time event. So adjusted EPS is a way for you to take that out and get a more realistic picture of the company's performance. It could also work in the other way too. You can say, oh, we had this debt that we suddenly had to pay off, or we had these unexpected expenses. So we're taking those out of the EPS outlook so that you can get a more accurate reading of the company. Now, the other one I was talking about was diluted EPS, which includes shares that haven't been released on the market but could be. So basically, things like warrants and stock options, right? So if you think about a company, if you go and you get a job for a company, sometimes they'll offer you stock options as a way to compensate you further beyond having to pay you actual cash, which actually I think is a good thing because if you have good stock at a good company, that could be worth quite a bit of money later. I mean, people that had stock options in Coca-Cola back in 1930, ended up with a ridiculous amount of money at this point because they would collect those shares every year, every month, whatever it was in their agreement. Um, but that tells you that the company has shares that could be put onto the market but aren't there yet. So those are shares that are locked up. Basically, it's like thinking about a pool that has a giant tub of water next to it that hasn't been dumped into the pool yet. So if the pool is semi full and then you dump the rest of that water in there, then you'll see it could overflow or there'll just be more water in the pool in general. But if you don't dump it in there, you just have it sitting there, you have the potential to. So diluted EPS basically says, all right, what is our EPS if we included the shares that have not yet been put onto the market? Which is an important thing to look at because at any point, some board member could have, millions of shares locked up for whatever because their contract says, hey, if you do this, then you get, another million shares of our company. So that person could get those shares and be able to unlock them and sell them onto the market in Q2, let's say, right? That would dilute the shares that are available, which means the EPS number would change based on that. So it's good to know what that would be if those shares came onto the market. So you have basic EPS, which is just the net income divided by the outstanding shares. You have adjusted EPS, which is the same thing but subtracting any one time events. And you have diluted EPS, which is the basic EPS plus the shares that have not yet been thrown onto the market. So I just wanted to bring that in there because I kind of use these terms sometimes, and I don't think people always understand what I mean. That's what I mean by those three things. So I just wanted to kind of bring that up since Rite Aid was a perfect opportunity to do that. Okay, so moving on to some other stock news. We had a little not a stock split in Kellogg's, but they are thinking about a company split. So Kellogg's is going to be breaking up into three separate companies. They're going to have their snacks division be a company, their cereal division be its own company, and their plant-based foods become its own company. Now, the reason that's interesting to me is because it actually allows them to put through price increases on some of their stuff. So those goods can be up, but they're going to have to be upped a little bit, considering you think how expensive it is to one get the ingredients for food right now. As we were talking about before, inflation is heavily coming from the food commodity sector. So having to raise prices in that regard will help cover a lot of the costs. But breaking the companies up like that also allows them to be a little bit more focused on those things because those, if you think about like cereal is a big division of Kellogg's. I mean, there's so many Kellogg's cereals if you go into the cereal aisle. So having its own company and being able to focus just on cereal will be good for that. What do we got here? TTV Apple Blow. Oh man, there you go. Someone's having a stroke on their keyboard over there. Thank you for that stroke. adding that to the chat. Very cool, very cool. So I'm happy about Kellogg splitting like that because that's bullish for them. If they have a drop, right, you can see they're actually not that far above their point of control if you're looking at the volume profile. The point of control is somewhere around 63, and they're about 70. So they wouldn't have to drop that far to be in the thickest part of the volume. And if they do, they're going to be putting in price increases anyway, so that's a positive thing for their company, not so much for people having to buy the stuff, but for the company. So if they drop more, I like them for a bounce in the future. I'm probably not going to do anything on that, but I'm watching them just in case. Because basically what I want is I want an extreme move of some kind. I need to be able to get in at a price that I actually believe in. All right, what do we got here? Juiced Gorilla 23. Is that typically the reason for stock splits? Usually, so this isn't a stock split. This is just a company split. A lot of times, stock splits come in because the price per share has gotten way too high. For example, Tesla in 2020, their price each share was about like $2,400 right before it split. So if you think about the smaller investor, some people only have like $1,000 in their account and they can't buy a full share of Tesla. So them splitting to where their shares cost, I think about 400. Yeah, they went for about 420. I mean, it's Elon Musk. He loves that number. So they kind of went down to that level, and people were able to afford it. If you have $1,000 in your account, suddenly you could buy a share of Tesla. However, the game has changed a little bit because fractional shares are a common thing now. Back in 2020, there was kind of being rolled out, but it wasn't really that extreme. In fact, let me open up Tesla so we can take a look at that. So Tesla's split in 2020 went really well. There was a huge bounce because of it. Let me zoom in a little bit here and scroll over to that. You can see this little pink dot right here was when Tesla split. And after that, boom, it kept going up because more people could get into the stock. Now that we have these fractional shares, you don't necessarily need a stock split. Someone could just buy a fractional share using whatever they have. Like Amazon, they just split. They were up at like $2,000 a share or something like that. Now they're at what, like 110, 120, somewhere around there. And it's much easier for people to get in. But if you wanted to just buy a fractional share, like let's say you have $1,000 account and you want to put, 200 into Tesla and 200 into Amazon, you can do that. So is there going to be a mania around the next Tesla stock split? I don't know. It's a different environment now, so we're going to have to see. But it is something to watch because Tesla is going to be pumped by things like Wall Street bets. The GameStop people, they're going to love a stock split in Tesla. But I don't necessarily know what it's going to do. So I'm watching it. I actually want to own Tesla long term. I've been buying fractional shares of it over time just because, number one, I could trade it if it does bounce on the stock split news, but I don't necessarily want to do that. I want to keep it long term. So I'm just going to keep dollar cost averaging into it. But stock splits are important still, so we'll have to see what happens. This year is kind of going to dictate how people are going to look at stock splits in the future. So we're looking at that over the next couple of months. What's going to happen. Tesla, I believe, has already filed for that split. I want to say it was like a 3-to-1 split, so not quite as much as last time, but they'll still hammer it back down to a couple $100, which will make it much more affordable per share. But it's something to look at, so we'll see what happens. Okay, so Tesla. Oh, speaking of Tesla, there was some more news on it. Tesla's actually being sued by some of the employees that have been laid off, so that's just another headwind Tesla has to deal with. There's so much stuff going on with it right now, and I really want Tesla to drop more because I've missed my chance. I had so many opportunities to buy it before anybody cared about it when Tesla was originally like $200, $300. It was sitting in that range for years, and I didn't jump on it. But now, I mean, if I had, even if I just bought one share, it would have been worth thousands at this point. So let's see what he got. Juice Gorilla. That's exactly what prompted my question. Thanks for breaking that down. Never understood that. Well, good. I'm glad I can help you out here. That's kind of what we do every Sunday. I watch the futures open and I go over stuff like this with the idea of telling people what I'm doing and hopefully bringing some clarity to things because it seems like a lot of streamers go on these extremes. Like either they're showing you technical analysis of like there's lines all over their chart and they're saying if it gets to this level, it's a Fibonacci thing and we can do that. That's all gambling. You really don't know about that. And then there's other people that are just kind of spouting out stuff about the end of the world. So I just kind of wanted to come in here and bring some, hopefully, more sane takes, more middle of the road takes. Like I want to be much more boring, right? Everybody wants to be extreme and get viewers. No, I want to be boring. I want to tell you what the middle of the road is, because that's usually where things lie. I mean, people put the extremes out there to tell you it could be at this extreme or that extreme, but usually it ends up being somewhere in the middle. And that's what I'm trying to do with all of this. So let's move on to the next thing. We're talking about Tesla. I want it to drop a little more. I've been buying a little bit of it. We'll see what happens. I don't know if it's actually going to, but it's the stock I like, and it's come down. So it's getting into that range that I like. The lower it goes, the more I'm going to buy on that. Okay, so moving on. We talked about Kellogg's. Netflix. Now, they had an awful quarter, right? If you look at Netflix chart, you're going to see these huge drops. And it wasn't just this quarter. Last quarter, they had some problems. They've been, at the beginning of the year, they were going down with everything else, but people were realizing Netflix has problems. I mean, if you own Netflix, think about how often you go on there and you spend like 45 minutes looking for a show that you actually like, right? Like, I think I was on this bandwagon before everybody else. When Netflix was getting really popular in, like, I don't know, the 2000 teens or whatever, people started going, oh, Netflix this, Netflix that. But every time I would log on and look for something to watch, I'd watch like a group of shows that I really liked, I thought were great content, and then I'd look for more and I wouldn't be able to find anything. So it would just be scrolling for 45 minutes until I get frustrated and turn it off. And I think that's kind of what's happened, because they put a lot of their money into developing content that was working. But I think they kind of put a lot of their eggs into one basket, and they didn't have a broad enough appeal to keep people on the platform after they watch the good stuff. It's like, yeah, Stranger Things is their big show, and it's making a lot of money, and people still really love it. I still hear a bunch of stuff about Stranger Things, this and that. But that's what do you do when you finish Stranger Things, right? There are some other shows on there, yes, but what do you do when you finish those too? Because that's what people do now. They binge shows like crazy. So Netflix is kind of, they came way down. They lost 200,000 subscribers in the last quarter, which is extreme for them. They haven't lost that many, I don't know, ever maybe, or in a very long time. And that dropped the stock by a serious amount. I mean, you got to think Netflix was $700 at the beginning of the year, right? Or I should say at the end of 2021. And now it's at 190. That is so great. I mean, it's come down so far. They announced that they're going to start adding an ad tier, right? So they're not putting ads on the paid version of Netflix. They're going to, I'm assuming it's either going to be free or it's going to be cheaper, and they're going to put ads on it, and they can sell that or the advertising space, get revenue from that, and that will hopefully pump them up. So that is kind of bullish for them. If they keep going down, I like them as a future pop as well. So the fact that they've come down so far, I'm already watching them. But this announcement is, for me, very bullish, and I like the fact that nothing really happened on that announcement. They said, hey, we're doing this, and nobody really cared, right? So that to me tells me that this stock is out of the public view. People don't care about it anymore. Everybody that still owns it is pissed off because they've lost so much money. A lot of people just dumped it and gave up on it. And that's when you want to start getting into a stock, because that's when stocks look good. You need to get in before all the air comes in, right? Like if you were trying to ride a hot air balloon, if it's deflated and sitting on the ground, it's not going anywhere. But you need that pressure to start coming in. And right now, all the pressures come out of it. So we can stand in the basket or we can start standing in the basket and wait for that pressure to blow it back up again. Because they're a big company and they're investing in this. They're not just going to sit around and keep doing the same thing. They're making changes. They've already sent internal memos to their people saying, hey, we got to work on these projects. And if you don't like whatever project you're working on, too bad, because they had all these, there's a lot of political stuff going on in multiple companies right now, and that's kind of hurting them. Also, the products just aren't as good as they were a little while ago, because they went heavy into some and not into others. There's just so many things that they're adjusting right now that makes me think in the future they might actually be good for a bounce. Will they definitely bounce? I have no idea. I mean, that's my thing. Like, if you ask me, is anything definite in the stock market? No. There are things that are close. There are things that are good odds plays, yes. But is anything definite? Absolutely not. So I really don't know. But in my gut, it's telling me that there could be a nice bounce, and this little consolidation period right here is starting to look like an opportunity. If it drops any lower than this, then I'm going to start looking at some plays. But I don't have anything going in Netflix right now, and it really has to, like, I love this chart. My kind of trades have this chart. I need a serious drop. I'm not as good at picking the shorts, but once things have really gotten hammered and everybody starts hating the stock, that's when I start liking to look into it. So yeah, Netflix is a good stock to look at. All right, let's go to the darling of the week, FedEx. All right, so last week I was saying FedEx had earnings this week and it was going to be a stock to watch, and man, was I right. It really popped. So FedEx was, it's such a good, it's number one, it's such a good stock to own, and number two, it's a great lesson for this week because they had so many things in their favor. Now, earlier I said my two favorite things for a movement in a stock would be one, guidance, two, analyst upgrades. So analyst upgrades usually follow guidance, right? So the way stocks will report earnings is we'll get into earnings season. They'll have a date that they're going to tell investors how they did for the last quarter. And then they're going to provide guidance for what they think they're going to do in the future. That's what guidance is. And that's why it moves the stock, because as I was saying earlier, the stock market prices in the future, not the present. The stock market is pricing in what this company will look like 6 months to a year from now, possibly more. So guidance helps adjust that prediction. Right. So FedEx had everything going for him this earnings season. Let me zoom in a little bit more so we can get that jump. This was nice. If you think about where it was. I mean, people kind of expected it to go up. I mean, that's why you see this green candle right before the earnings break came in, but it gapped up a little bit and it was hanging out higher than it was when it closed. Well, let me go over here to this. So here you go. You can see the price action a little bit better. You can see it jumped right on those earnings, right? See, this is when the earnings were released, the morning, like Thursday morning or something like that. And it jumped, right? It had a little bit of a cool off period, but then it jumped again. And I'm kind of surprised it didn't jump with the market at the end of the day because the market hiked huge there. But the reason I liked this earnings from FedEx was because their earnings per share EPS was in line with estimates, right? They said they were going to earn $6.87 a share, and the estimates were about $6.88 a share. So even though it's a penny lower, that's still basically right on with the estimates in my book. If you're like within a few cents, to me, that's a hit, right? You made it. The revenue came in at 24.4 billion, but the estimates were a little higher. They're 24.5, so not that much higher, but a little bit. And the other thing they had is they had a lower volume of packages shipped. So you would think, okay, FedEx kind of relies on how many packages they ship for their income. So you would think that would be a bad thing. But they were able to offset that with price increases, right? So they raised their shipping rates and their fuel surcharges, which helped offset the lower volume of packages, which is why they still made money, or they still made the estimated amount of money even with fewer packages coming through their warehouses. So that was good for them. I mean, the increase in prices helped. They also had a $46 million tax benefit, so that helped them in the quarter. They guided up for 2023, which, as I was saying before, is bullish for the stock. And that's the real reason why things went up, because they basically said, hey, we're going to make even more money next year. We're guiding up. That's one of the most bullish things. They also announced a share buyback. So next year, in the first half of 2023, they're going to spend $1.5 billion buying shares back. And if you own shares, that's extremely bullish. Man, we got somebody's going crazy on that keyboard down there. TV Apple blow. You're going nuts, man. Is everything all right? I see a couple of words. You actually got a couple of words out there, Susie Duffy. Man, you're getting something. So we're trying to get there. All right. So back to FedEx. The last thing that I wanted to say. So all that everything I said was bullish. They also had the dividend, right? They said they're going to have a higher dividend that came in last week, which pumped the stock up because there was an investor, an activist investor that wanted that. So this $1.15 dividend you see right here is significantly higher than it was last quarter. It was like 75 cents or something. So it's a huge jump in the dividend. That's another bullish thing for them. And then the next morning, after everything came out, they had analyst upgrades. They had a whole slew of analyst upgrades. If I bring up the news here and bring it onto the screen, there's Stevens adjust FedEx price target to 295 from 285. JP Morgan adjusted to 284. So basically any of these price targets you see right here, what is it? There's a Stevens one again. They're all guiding up. They're all saying, okay, we think the stock's going to be higher. So that is both upward guidance and upward analyst projections are two of the most, if you have them together, are two of the most bullish things for a stock. I'm actually kind of surprised that this didn't go up further. I mean, let me see how many shares they have. They probably have a giant 250 million share or 260 million shares, that's not a lot. I'm kind of surprised that this didn't pump even more. But I do actually think the reason for that was because when they announced the dividend, so that was last week's thing. So if I switch this to daily, we can get a better look at what actually happened here. You can see this pop right here, right? So last week, FedEx was down at $200. They said, hey, guess what? Our 75-cent dividend is now going to be $1.15. Huge jump. That pumped the stock. And it kind of traded in range, and earnings pumped it even more. So really, the stock has gone from 200 to 240 in a matter of like a week because of all this bullish stuff. So if you owned FedEx before that, you're sitting pretty right now. FedEx is looking wonderful. All right, what do we got? Life of Ronan. Hey, stock, I'm going to be lurking. Picked up a shift, so I won't be streaming tonight. Great job on the stream, bro. Very informative. Looking forward to watching more of your content. Hey, thanks for sticking in, Roland. I appreciate that. So see you later, man. Have a good one. All right, so FedEx looking good. That was the last stock I wanted to talk about. How we doing on time? 4:30. Okay, cool. We're still moving. All right, so the next thing I wanted to talk about was some stuff in the crypto space. So crypto had an interesting week. One of the fears that people have with cryptocurrency is getting hacked because that seems to happen regularly, right? So this week, Harmony was hacked. They are, what is it? They have a bridge. Yeah, Harmony is the company, and the thing that was hacked was their bridge Horizon. So I didn't really know a whole lot about cryptocurrency bridges, but basically what they are is a way to move your coins from one blockchain to another. Now, here's the interesting thing about these blockchain bridges. They actually mint new coins. Right. So some of one of the purposes of cryptocurrency originally was to make things scarcer, to make it more decentralized, to keep inflation down. Because part of the problem with fiat currency, which is what the US dollar and, pretty much every currency around the world is that it can be inflated infinitely. There's no limit on how much the government can print money, right? So cryptocurrency was supposed to be a block against that. However, these bridges kind of work against that concept a little bit, right? You think about coins being scarce, but then you think, okay, in order to move these coins from one blockchain to another, there needs to be a way to do that. And the way they do that is they lock up coins on one chain and then they mint new coins on the other chain and they call it a wrapped currency basically. So the bridge that got hacked, this Horizon bridge, actually, what did it see? It transfers ETH to Binance Smart Chain. So if you have Ethereum and you want to move it onto the Binance chain, you could have used this Horizon bridge to do that. And Horizon would have basically locked up your Ether and then minted new Binance coins and given it to you. But what does that do if the coin on the old chain isn't destroyed? Then what happens to it? Well, it just sits in the bridge. So hackers have been trying to get at these bridges and grab that coin. So in other words, you wouldn't have a single coin, you'd have two copies, right? One on each chain. One that's been taken from the bridge that was supposed to be locked up, and the new one that's been minted on the new chain. So this week, hackers were able to take, let's see, what was it? $100 million worth of crypto off of this bridge. It actually now the FBI is involved because this is a huge thing, and this isn't the first time this has happened. Wormhole was another bridge. It minted 120 wrapped ETH without staking any, or I mean, the Wormhole hacker was able to mint $120,000 worth of ETH without staking any in the first place. So they were basically able to create new coins and take them. And then there was another. Let's see, what was the other chain that have? Okay, so 600 million was taken from Ronin Network. 320 million taken from Wormhole. So these bridges are under attack because they're vulnerable. They're basically just like a coin purse sitting in the digital landscape waiting for somebody to figure out how to take them. So there's a lot of criticism with these bridges, but you also have to think it's not always easy to spend one type of cryptocurrency, and the ability to exchange that. Like if you're going to another country, let's say you're in the US and you go to a country that has a different currency, you need to take your US dollars to an exchange and be able to get that local currency to use there if they don't take the US dollar. And it's the same way with cryptocurrency. So a lot of people will want to move from one to another in order to use that cryptocurrency in whatever way they decide. So those bridges are kind of necessary, but they're a target. And here's the other thing that's interesting about those bridges. There's basically like two main types. It gets a little bit more complicated the deeper you go, but there's a trustless bridge and a federated bridge. And a federated bridge is kind of like a more centralized thing. It's basically like you're assigning a small group of whatever, people, nodes, something, to hold and transfer that money. Whereas if you have a trustless bridge, you're doing it on the blockchain with a multitude of units. So it keeps it more decentralized. But these federated chains kind of allow centralization. And that's one of the things cryptocurrency is trying to avoid is that centralization. So having these bridges, not only are they security risks, but they also kind of ding at the philosophy of cryptocurrency in general and throw that argument out the window. Because one of the things you'll see if you talk to somebody that's really into Bitcoin, they'll always give you that like, oh, it's scarce, oh, it can do this, oh, it can do that. It's decentralized, so it's not as easy to control as everything else. And to an extent, that's true. It is a little bit more decentralized than your average central bank currency, but it can still be forked. The developers can say, hey, we want to change the way this goes. So at whatever block, we're going to fork the chain and make a new currency. That's basically a way to do whatever you want. So if they decide in the future that Bitcoin, which is supposed to have 21 million total when it's all been mined, and that's the cap, they could fork it and make it more. So it's not like it's inflation proof, but it's more in the right direction. So some of this stuff, it's stuff that's coming in because we're still learning about this space. Cryptocurrency and blockchain are still extremely new in the grand scheme of our history. We've only been dealing with this for the past couple of decades, really, but and not very long. I mean, I don't know exactly when the blockchain technology was invented, but it was turned into cryptocurrency around 2009. So that's when we started thinking of it as a way to decentralize currency. Whether or not that will continue in the future, I don't know. But these hacks are a big problem for cryptocurrency. A lot of people that aren't into it think of these hacks as a reason not to get into it. So they think, I don't have to worry about my US dollars getting stolen from, the as easily as people could steal something like an altcoin. It's not as secure because there's just not as much use. And the more adaptation it has, the harder it is to hack these things because it takes more power if you're using the traditional hacking methods. Now, what if there are other methods that we haven't discovered yet? Those pose a threat. And I kind of believe that there are. I think since we've only been dealing with this for so long, at some point there may be some hardware or software breakthrough that allows people to crack these cryptocurrencies and turn them into worthless coins and basically mint as much as they want. But is that actually going to happen? I don't know. I don't necessarily think it's definitely going to happen, but I know it's a possibility, and it does worry me. So I try to make sure that I'm not too stuck into it. In fact, since we're on cryptocurrency, let's take a look at the Bitcoin futures right now and just kind of see what they're doing. Because we started a new contract cycle. So that was something I was trying to talk about next week. Or I mean last week, but I was having trouble with the charts and I wasn't able to get these lines. These red lines right here are the new contract cycle. So you can see during this last cycle, it kind of bottomed out right here, and we started a new one at the 20,000 level. Nothing has really happened. It's still kind of hanging around at that level. But since we have a new contract cycle, not just in Bitcoin, but in general, because this is the end of the quarter. So even if you look at, in fact, let me go to the S&P futures slash yes. So they're not show. There we go. We are showing those. See, they started a new contract cycle too, and look at where the turnaround is. This is why I mentioned that. I say like new contract cycles are something to look at because you don't always know if the trend is going to continue once things change over. In fact, things change frequently. Look at the last contract cycle. Things were going down, and then the contract cycle hit, and they started going up again. Right? They crashed right at the end. But look what happened at the beginning of the next one. Boom, big crash. Now we're kind of having a pump at the beginning of this one. So it's good to look at the contract cycles because this is when people readjust, like big institutions readjust their positions, especially at the end of a quarter. Like there are monthly contracts, but the quarterly contract cycles are the really important ones. And since we had a shift in one of those just a little while ago, in fact, this was the first week in the new cycle, it was good to look at and look what would have happened if you had bought in down there. You would have made some money. So I'm looking at cryptocurrency and everything else in general in this new contract cycle and seeing what's going on. Oh, look at this. I actually have a line that I drew there. Interesting. In fact, I drew that a little while ago, so that was kind of one of my estimates as to where things could pump up to. Since we're on the S&P now, I can see this hitting this line. In fact, look, it's in line with this moving average right here. This is the 50-day moving average, which would be a place to turn around. In fact, if you look at how it's performed at the moving average in the past, it kind of came up close to it and got rejected. So it is possible that we get up to here and we go down. But if we did, look at that. It would be a lower high still because we got a high there, high there, high there, high there. Each one of them is lower. And so if we get another one of those, that only confirms the downtrend, which is why I say I don't necessarily think a rally is going to sustain. I do think we could have a longer rally than I originally expected because we have more positive news coming into the market. People believe the Fed is on the right track, so they're not as worried about things and more likely to make stupid trades that pump the market up. So I wouldn't be surprised if we actually did get a pump all the way up to this line. So that would be cool because if it hit this line and or somewhere around here and turned around, it would keep things in line and it would allow buyers to continue to buy and it would scare people into selling and dropping prices, which is what I want. I want to be in a buyer's market. Last year was difficult. I didn't have enough to just write everything up. I wanted to get in, but since things were always at highs, I never felt comfortable buying in. This downtrend has made me feel so much better. I've been buying little bits here and there, and I think that's the best way to do it. Add to your long portfolio slowly and only with the money that you're okay losing if things go south. But it's still an opportunity to add slowly and dollar cost average over time. I mean, even when it's going up, you can still do that, but when it's going down, it's even better. It's hard to see, but I'm very happy about this, and everything is looking really good. So, the last few little notes on cryptocurrency. So, let me go back to, let's go to the ETH futures this time, just to see what's going on. ETH is pretty much going to look exactly like Bitcoin because everything kind of trades in that Bitcoin frame. That's just how cryptocurrency goes because Bitcoin's the OG. It has the biggest following, the most volume. So what else did we have? Ape Fest. Right. If you've heard of those NFT tokens, the Bored Ape Yacht Club, they had Ape Fest, their second annual Ape Fest that wrapped up in New York City this week. Um, if you had a Bored Ape NFT, that was your ticket into the festival, so it was basically a way to get in there. Um, but some interesting news on the NFT front. There have been a few retailers that are adding NFT sections to their site. Like for example, Shopify had added a token section that would be exclusive deals for people that owned NFTs, which is cool. If you have an NFT, you can go into the shop and be like, "Oh, these are deals that only people with these NFTs can get," and it's kind of a way to get some value out of your stupid picture of an ape, right? I mean, these things are terrible, but they're popular, so there is some kind of value in them just for that. But is the value the greater? Is it a greater fool value or is it actual utility? And having it be a ticket to get into to a show brings it some actual utility. But I mean, it's only utility when that show's going on. So what I want to see with these NFTs is what they have, what they can do in the sense that what utility do they have? If there are they just an image? Do they look cool? And there's just nothing but clout behind it. So when people get tired of it, it just goes away. Or when the hype dies down, is there a use case which will keep it around? And I think a lot of cryptocurrencies actually have that, and that's why the market's not falling to zero. Because the useful tokens are getting a little bit of a boost compared to everything else that's getting crushed by this rally. And this is what you need to have happen. If you look at things in the grand scheme, in fact, let me get back to the other screen so we can see things a little easier. I wanted to take a look at ETH in the longer term, or actually, I wanted to take a look at cryptocurrency in the longer term. So let me go with week, and let me switch this to the Bitcoin futures. This is what we're looking at long term. When I originally started getting into cryptocurrency, it was somewhere in 2018. I remember I was buying in this like 6,000 level, and then when it crashed down to threes, I halved my entire investment in a matter of like weeks or months or something like that. So this is when I was accumulating right here, and I ended up getting rid of the stuff when it started to pump up, like when it was like 12, 14K. So I had some, but not a lot for this. But if you think about the people getting into this mess, they were up quite a bit and they're way down. People hate cryptocurrency right now because it was trading at 64K, Bitcoin was, and now it's at 20. It's terrible right now. But this is what I'm liking. So if you look at the chart and the volume, we're starting to get down to an area where more people accumulated because most people that hold this currency got in this area or earlier. There are a lot of people that have been diamond hands holding this thing for like 10 years or more, right? And there are some people that have been holding it for like 5 or 6 years and they're up too. I still have a little bit of it, but I ended up getting rid of most of mine up here around this peak. I got lucky and actually dumped it on this peak day before it crashed, and I ended up start buying back in this mess, so I'm still down on everything. But that was a nice little trade to get a little on this drop and then dump it right up here. But anyway, my point about this whole thing is people are really hurting right now. This has gone down. Favor has fallen out of the crypto market. A lot of the fair weather fans are gone, so it's a good time to look at buying back in. And the profits I've been getting on my trades, I've been using to buy things like crypto, things like Tesla, things like Amazon, and hopefully Apple at some point because I really want to own Apple. It's the best stock in the market basically. They're running into some issues right now too, but it's still Apple. So if Apple gets hit really hard, I'd love to get them, and that's what I'm doing with my wins. I'm just trying to take them and add to my long portfolio. And part of my long portfolio is cryptocurrency. I don't have a whole. I don't think you necessarily have to have a huge percentage of your portfolio be cryptocurrency because with how volatile it is, just a little bit could go a long way. And with how volatile it is, if you put too much in and it keeps going down, you can really get hurt. So that's why I'm looking at things slowly, right? I've been buying slowly in this downturn, and as things start to come down to areas where there's more volume, I'm going to up my buying and be a little bit more aggressive with everything. So let me see. I had a couple of points to go over in the crypto thing before I was finished with all that, and I wanted to wrap it up. So we talked about the Harmony hack. We talked about Ape Fest. Oh, so here was something that came up during the Fed meeting with Congress where Powell said he wants better regulation on cryptocurrency, which is basically what everybody's saying right now. There are too many scams going on in the cryptocurrency market, and things are really difficult for people that aren't that familiar with it but want to get into it. There's so many people that have gotten scammed that it's turning people away from the market. So some kind of regulation is going to be necessary for these things because of that. But there's also the threat of cryptocurrency. Some people realize that cryptocurrency could unseat the US dollar as the world currency, which would take away the power of the United States to use economics instead of tanks and guns. So they don't want the power of the dollar to go away. So they're fighting cryptocurrency to keep it from being a threat to their military and financial superiority. Which you can have whatever opinion you want on that, but in a fundamental level, they're right to be worried about cryptocurrency because the problems with fiat are the reason cryptocurrency exists. The whole reason that people got into it was because they looked at the inflation and the money printing in fiat and dumped it. They thought, this is hurting me. If I'm just holding cash right now and they keep printing money, they're taking money from me directly by doing that. Cryptocurrency should be a way to get around that. Obviously, because it's so volatile, it's not there yet, but it does have the promise of going in that direction. So something somewhere will eventually become a threat. Because the thing about life is what works eventually wins out over your opinion. That's kind of the situation we're in. If you look at why political rhetoric is so extreme right now, it's because everything is going so well that people are able to say whatever they want without consequences. They're able to do dumb stuff without consequences because we have a system that keeps that going. If you were exposed to reality and when you did dumb stuff, you were punished by reality for it, you would have to find the right solution in order to survive. And that's what happens. Eventually things get tough enough to where you need the good solutions. When things are good, you can get away with BS. It's so easy to do. That's what we're in right now. But when times are hard, you need to actually know what works. And I think if something works, it will eventually overpower all the rhetoric around it. So if a very useful cryptocurrency comes up that really does solve the problem of money printing and inflation and the control in a minority of people over the majority of the world, then people will gravitate towards that, even if the people in control try to stop it. So cryptocurrency looks like something that could be a hedge against that. And if it does actually become a threat, then the people that have fiat currency as their weapon are going to be they're going to be unseated. So they're doing everything they can to block it. That's why crypto regulation is so important because we need regulation to protect people from the scams, but we don't want it so heavily regulated that it loses to fiat in the battle for superiority, right? Because like personally, I want the best currency to win. I don't care what it is. If it's better to have a centralized currency in the grand scheme of things, then I'm okay with that. If it's better to have a decentralized currency in the grand scheme of things, I'm okay with that too. And there's going to be some differences as time goes on. There are going to be some problems with each one, and we'll have to see what those how those things work out. By the way, Dreamwalker84, thank you for the subscription. I appreciate that. That's wonderful. Glad to have you here. So let me move on to the last section of crypto. The last thing I have written down here is crypto.com, Genesis, Sparrowtech. They're all going to be in Singapore. They got permits for approval to issue tokens for payments in that city state. That's bullish for crypto because that's more adoption, which is what we need. Speculation is one thing, but if it doesn't have any fundamental adoption behind it, it's not really going to go anywhere. And that's kind of what happened with this big pump. People thought it was going to go faster than it actually did, but when reality sets in and things start to get hard, then people sell off, the currency drops, it's had huge moves, so there's not a lot of support to keep it from dropping. So what we need is a fundamental use case to give it some ground. If people use cryptocurrency more and more, it will give a chance for the buyers to feel confident enough to come in. So that's bullish, and that was the last thing I have written down on my list for cryptocurrency. So I'm going to wrap things up here. It's kind of a shorter stream than I normally do. It wasn't one I was feeling before I got into it, so I'm glad I got through everything. It wasn't too bad. The things I wanted to take away from today's stream is one, we have earnings season coming up. Right, earnings season is extremely volatile, and earnings season is when I make most of my moves. So I'm mostly in cash right now. I don't know what everybody else's plan is, but because of the uncertainty, I wanted to take off everything but my most sure positions and just add to them. But I want to have cash on hand for when we get into earnings season, and that's like the middle of July. Usually the banks kick everything off. When you'll see the banks report earnings first, and that kind of gives you an overview of what might be happening later, since the banks lend to everybody else. It's good to see how they're doing. That'll also give us some information on how monetary policy is working out. So we'll see the banks report first, and then we start getting into the companies that get interesting. So let me actually go to the calendar here real quick so we can take a look. We're in June. I want to go to July. So right around here, I believe, is when the banks are coming in. Let's see if we can find some of them to confirm that. Yeah, JP Morgan. We got Morgan Stanley. So yeah, there's a few banks coming in the second or maybe third week of July. And then we get into the heart of earnings season. So you see right here where it says like 81, 307, 434, 705. This is the heart of earnings season. This is when most big companies actually start reporting, and this is when volatility picks up. Also, it just so happens that there's going to be a rate announcement right in the middle of this. So right at the heart of earnings season, we're going to have one of the biggest Fed announcements in a while, notwithstanding the previous one. We're going to have earnings season. And we've got the mess of everything else: the Ukraine war, the shipping situation, inflation. We're going to have some more numbers from the CPI. We're going to see, what's going on with the housing market and the job market. So everything's kind of culminating right here at the end of this month. So I want to be in cash for this in case there are huge moves, because I have a feeling with everything moving at the same time, people aren't going to be able to react to everything correctly, because people are going to have to react to the Fed at the same time they're reacting to, let's say, I don't know, Apple and Google and all these giant companies reporting earnings. That's going to move things. So it's just going to be a crazy mess, and I'm getting ready for that. That's kind of my plan. I'm going to try to be as quiet as I can over the next couple of weeks and do as little as possible. Maybe lean into some shorts and try to get out of them right before the earnings season comes up, because my prediction is, since all that stuff happening at once, we're going to have a little bit of a drop right before we get there. So we're having a pump right now. It might go into next week, maybe a little bit the week after. I'm not sure. It could also drop. I'm extremely uncertain. The last few weeks, I've been mostly certain that my prediction was going to come true, and it's mostly been right. I was saying it's probably going to go down every week for like the past 2 months, and then last weekend I said, it's probably going to bounce next week. It might go down, but my gut feeling is it's going to bounce, and it did. But that bounce wasn't very strong until the very end of the week. So that's why I'm so uncertain about this. If the bounce had been more clear, like let me go back to the charts and open up the S&P real quick. If the bounce had been a little bit more clear, then I might have had more confidence in saying that, yeah, it's definitely going to bounce again next week, or it's most likely going to bounce again next week. But let me switch this back today so we can get an idea of what actually happened. But since you look at the week, most of it was in that same range, right? It opened up. In fact, let me go to this grid because that would help us see it a little bit better. And let me open this up to max, right? You can see that when it opened up in the beginning of the week, where's Monday? So we got Friday. We may not see it. There's Tuesday. And my chart only goes back there. So actually, let me see if I can go a little bit farther back. 10 minutes, 10 days. There we go. That'll make it easier to see. So Monday, right here, it gapped up. You can see it hit a low on Friday, and then it started pumping and gapped up Monday morning for the open. Right. So let's say this is the previous week's close right here. This is the open for last week. It sort of trended up, but if you look at it, it was up, down, up, down. It was very uncertain until the very last day on Friday when everything pumped and then squeezed right at the end of the day, right? Just up. Actually, no, this is Friday. I'm sorry. So it's pumped in the morning and then squeezed at the end of the day, and that's kind of where it's sitting. If it had been much more up, I would have said, okay, we have good momentum. But since it mostly was flat, like if you look at through the whole week, my S&P chart was just kind of sitting at this line. It would come up to that line, go down. Come up to that line, go down. It just wasn't breaking through. Um, it, which is why I kind of think this was more of a squeeze than an actual movement. So I'm extremely uncertain. I have no idea what's going to happen tomorrow. I do think that there's going to be something, but I don't necessarily know if it's going to be up or down. So we'll have to kind of see what goes with there. That's why I want to be in cash. I want to wait. If this move continues, let's go back to the long-term chart, switch it to the weekly. So if this move continues and we have a nice little bounce up to one of these resistance points, then I'm looking for a downward movement after that because the Fed wants to crush rallies. Until the price of oil comes down, until the food prices comes down, there's not really going to be a reason for the market to rally super hard. So I'm kind of looking in cash for a little bit, waiting for hopefully a little bit more of a pump and then a drop going into earnings and rate announcements. So that's my prediction at this point. Maybe a little bit more of a pump and then a continuation of this downward trend that we've seen the entire year. So how do you want to play that? That's up to you, but my opinion is I want to be in cash in case there's an overreaction to anything. I really hope next earnings season has some crazy volatility because that's when I'm going to be able to make money. We had a terrible earnings season this quarter, which sets up a bounce in the future, and that's what I'm waiting for. Right? Having all this stuff together could provide a huge bounce. Or if we still have to wait because the economics don't look that good, the macroeconomics don't look that good, then that bounce could be sustained for a little longer, which would also be good because that's what I'm waiting for. I want to bounce. I do short, but I'm better at trading bounces than I am anything else. So that's kind of the deal for the week. If anybody has any statements, any questions, any comments, throw them in the chat real quick. We can talk about them before I get out of here. But that's mostly what I wanted to talk about. We had a busy week with the Fed talking to talking to Congress. Basically, the Fed was kind of in line with everything they said during the rate hikes. They just sort of reiterated it to Congress, and the market liked it. The market found it to be a positive thing, which is why I think this bounce could go a little bit more. But because it didn't have a lot of strength behind it, I'm not sure. Here's another interesting fact. We had that bounce, but look at the volume. The volume's low. Like let me bring this up a little bit so we can see get a better picture of what the volume actually looks like. Oh, I'm having trouble grabbing that little thing right there. Okay, so you can see these are the volume candles for each week. Last week's volume was not that high. Right. So that's not really confirming that move. That's another reason why I don't think that bounce has much fuel into it. I think maybe we'll see a little bit more next week, but there could be a turnaround. So I'm sitting on the sidelines for the most part, just waiting to see what happens. I was very certain with the last few weeks. Now I'm less certain. So to me, instead of trying to force a trade, I think the best thing you can do is just wait until you see something that you actually know. And that's what I want to do. I'm better with earnings trades. I get into these little trades in between earnings season, and to be honest, most of them don't work out. The way I work is I have like a really good trade, in one quarter, and then a couple of okay trades, and then I'll just have a bunch of little tiny ones that don't do anything or they're terrible, which is why I keep them small because I'm not certain about them. Sometimes you're just kind of playing around. You're like, oh, I think this might go up or down. I'm gonna play that. And since I use options, you can actually kind of do that cheaply sometimes. Sometimes you can throw like 20 to 40 to $50 at something, and it could turn into like 1,000 or two. It's rare, but it does happen. So every so often, I'll throw some money at those kind of plays, but I'm not sure about them, so they end up not working very well and dropping. So that's pretty much it. It's been an interesting week. I'm excited to see what happens next week. I'm really liking doing these weekly streams. Doesn't look like there's any questions to go over. I got a few, let's see, follows today. Risen29, Juiced Gorilla. Thank you very much for your follows. Jabari Boy 23, thank you for your follow. Dreamwalker 84, I really appreciate the subscription. That's wonderful. Everything helps. It's been a really interesting week. I can't wait to see what happens and get back to you next week. So stay safe. Just as a reminder, I'm not a financial professional. I don't give financial advice. I'm just giving my opinion on everything. And hopefully it's something you could learn from, or it's something you can add to your knowledge bank to think, all right, I don't necessarily agree with this guy, but these are decent points, so I want to be aware of them. That's kind of my thought. I don't get stuck on any one thing. I want to have as much information as I possibly can to make a trade. And that's what I try to bring to everything here, because I'm an intermediate trader. I'm not an expert. A lot of people that come into the stream are in the same vein. In fact, most people that are trading are like that. They're either beginners or intermediates because they got in a time when it was easier to get in. A lot of the professionals that have been in for a long time, or people that have just invested for a long time, they have an advantage because they got in before everything went crazy. Now everything's crazy, and it's a whole different world. So there are opportunities to make money. They're not always what you think, so that's why you need to be careful. And anything you're looking at, know that we have volatility. We have it. Oh, that was one more point. I'm sorry, I forgot one thing before I close out the show. This is an election year, all right? We have the midterms coming up. So if you took out inflation, supply chain, Ukraine war, the Fed raises, all the big stuff, if you took that out of the equation, we would still have volatility from that election. We have an uptick in the rhetoric of political, basically political rhetoric is extreme right now because people are getting in positions for this election, but what they're really doing is they're posturing for the 2024 election. So we have a whole lot of volatility because there's so much uncertainty. I mean, things could flip quite a bit in this midterms, and that'll kind of change the direction of how things go into the actual presidential election. So the volatility from that is crazy alone, and then you add the rest of the craziness into it. This year is going to be insane. I mean, every election year I've looked at has been volatile, but we have so much more going on. So I can really see things getting out of hand if things turn down for the worst. If this bounce, doesn't last very long, and people end up realizing, hey, this is going to be difficult, we could be in for some serious pain. Which is why I say, like, have some cash ready. But you never know if things clear up and there could be a bounce. Which is why I also like having long stocks, so that way I'm protected both ways. I trade a little bit to the downside and I invest to the upside. So that's kind of my philosophy on everything. So good luck with everything this week. Stay safe. Do what you can. Try to get as much information as you can before you make a trade, because right now there's so much stuff that can affect it. Even if you're right, you can get destroyed. So be careful out there. All right, I'm gonna get out of here. It's been an interesting week. Have a good one, and I'll see you next week.